Hi, I'm the Quant. In this episode, we're going to lay the foundations. No Lambo promises, no magic curves. We'll look at the real rules that help you avoid blowing up your account, progress in a clean way, and prepare the ground for algorithmic trading. First, we'll talk about rules for normal, manual trading. Then I'll show you how those same rules translate into a trading robot. Let's get started. We'll define what good trading actually looks like in practice. We'll focus on simple, concrete rules you can apply right away, how not to blow your account, how to progress step by step, and how to prepare for algorithmic trading. The goal is that by the end, you know exactly what you should expect from yourself and from your robot. A good trader is not someone who predicts the market. A good trader is someone who manages three things correctly: their capital, their strategy, and themselves. We'll look at simple rules for each pillar with concrete examples you can actually use. First rule: you only risk a small part of your capital on each trade. In practice, that means between 0.25% and 1% of the account. 2% is already aggressive, and above that, you're not trading anymore, you're gambling. If you have a $1,000 account and you risk 1%, that's $10. If your stop is hit, you lose $10, no more. You can lose 10 times in a row and your account is still alive. That's what survival looks like. Let's take a simple example. You have $1,000 on your account. With 1% risk per trade, your maximum loss is 10. If your stop is hit, you lose $10, not $50, not $200. That means you can take a series of losing trades without destroying your account. The real secret of trading is not finding the perfect entry. It's staying alive long enough for your edge to play out. Second rule: you define a daily loss limit and a monthly loss limit. For example, if you lose 3% in a single day, you stop trading. If you lose 10% in a month, you stop, you analyze, and you do not keep trading to make it back. That's exactly how prop firms work. They have a daily loss and a max drawdown. You don't need a lot of money to succeed in trading. If you manage risk well, you can start small, prove you're consistent, and then use prop firm capital to scale. The key isn't the size of your account, it's your ability not to destroy it. Before you enter a trade, you already know your invalidation point, a specific price, a zone, or a distance based on volatility. That invalidation is your stop loss. You never enter the market thinking, "I'll see what happens and I'll decide later." No. You decide before you click, not while it's burning. Your stop is the bumper that protects your account. A good strategy does not start with, "I stacked 3 indicators and it looks good." It starts with a clear idea. I want to follow trends. I want to buy panic and sell the return to the mean. I want to trade range breakouts. Your indicator is just a tool to formalize that idea, not the idea itself. A strategy is not supposed to work in every condition. Some methods are built for strong trends, others for ranges, others for periods of high volatility or very quiet markets. Being a good trader isn't about forcing your strategy on all markets. It's about knowing when to use it. And even more importantly, when not to use it. The more filters, indicators, and conditions you stack, the more likely you are to build something that only works on past data and collapses live. A few simple, coherent rules, properly tested, are worth much more than a monstrous system optimized to the millimeter. A strategy you understand always beats a magic one you don't. You don't take a $100 risk to aim for $50. You define a minimum reward to risk ratio, for example, 1.51 or 2.1. That doesn't mean every single trade will end exactly with that ratio, but it forces you to look for logical setups, not random entries. The goal isn't to win every trade, it's to make the average of all your trades positive. Before you put a strategy live, you go through 3 steps: backtest on historical data, test on demo or with very small size, and only then increase the position size gradually. You don't reverse the order. Your real money is not a beta test. You validate the idea first, and only then do you commit capital. Without discipline, even the best strategy dies. You need a written plan, you need a trading journal, and you need to separate good decision from good outcome. A loss does not mean you're bad. A win does not mean you're a genius. You judge the quality of your process, not just the result of a single trade. If your plan lives only in your head, in reality, it doesn't exist. You have to write down when you trade, what you trade, your setups, your position size, how you manage losses, and what you do when you hit your daily limit. Once it's written, you can ask one simple question after each session. Did I follow the plan, yes or no? Without a journal, you just repeat the same mistakes. In your journal, you can note the setup you took, your emotional state, stressed, tired, excited, whether you followed the plan and the result. After 50 or 100 trades, you clearly see what works for you and what is killing your performance. A loss is not a judgment on your value as a person. A win doesn't prove you're a genius, and a loss doesn't prove you're useless. What matters is the quality of the decision. Did the trade respect the plan? Was the size correct? Was the reward to risk ratio logical? Everything else is noise. Now comes the part you're probably most interested in, how all these rules apply to algorithmic trading. A robot is not a crystal ball. It's just a tool that applies your risk rules, your entry and exit rules, and your market logic, without emotion, 24/7. Everything we said about risk can be coded into your robot. Risk per trade becomes a parameter, like risk percent. The stop loss is mandatory. The robot calculates volume based on stop distance. You add a daily loss limit. If the loss exceeds X%, no new trades. You add a drawdown limit. If equity drops more than Y% from the high, you close or pause. Even if you're tired, stressed, or on your phone, the rules do not move. Your robot doesn't guess anything. It follows the logic you decided: trend following, range, mean reversion, breakouts, grid, controlled martingale, whatever you choose. If you want to use a grid or some form of martingale, that's not a problem by itself. The real questions are, what is the risk per cycle? What is the global stop? And how far are you willing to average in? Here's an example of a sane framework. 0.1% risk per level, with a global stop of 1% for the whole cycle. If the cycle reaches 1%, you close everything and you restart from zero. It's no longer an infinite martingale where you just pray. It becomes a controlled strategy with clear limits. The huge advantage of a robot is that it automates everything we've just seen. You define your trading hours, days, instruments, risks, and limits. Then you simply monitor: open positions, P&L, drawdown, stats. The robot doesn't stress, doesn't take revenge on the market, and doesn't double the size in tilt mode. It just does what you told it to do. To sum up, good trading is not about a secret indicator. It's about clear rules on risk, on strategy, and on your own behavior. A robot doesn't replace those rules. It simply applies them automatically. In the next videos, we'll build a robot together, not to invent the signal for you, but to manage your entries, your exits, your money management, and your loss limits. If you haven't already, subscribe, drop a like to support the project, and join the Discord to meet the community and get answers to your questions. Stay focused. I'll see you in the next episode.